All right, let us look at the first MCQ, and that is firstly, whenever doing the MCQs, look at the requirement. And what's the requirement? Identify whether the cost listed below should be capitalized or expense. Right. So I-16 property, plant, and equipment requires an asset to be measured at cost. Okay, at measure at cost on its original recognition in the financial statement. AW use its own staff assisted it by contractors when required to construct a new warehouse for its own use. Now, firstly, clearance of site prior to commencement of construction. Well, we will capitalize it. Professional service fee for managing the construction work, it will also be capitalized. EW own staff wages for time spent working on construction, it will be also capitalized because it is specific to a project, right? It's not general, it's specific to a contract, so it will be capitalized. Then appropriation of EW administration costs based on staff time spent, it will be a general cost, so it will be expense. It's not related to a particular project. Now, on 1st July 2004, experimenter opened a chemical reprocessing plant. The plant was due to be active for 5 years until 30th June 2009, when it would be decommissioned at 1st July X4. The cost of decommissioning the plant were estimated to be 4 million in 5 years time. Experimenter considers that a discount rate of 12% is appropriate for the calculation of a present value, and the discount factor at 12% for 5 years is 0.567. So the cost of decommissioning is assumed to be an obligation for an right. So what is the total charge to be statement of profit or loss? Okay. In respect of the decommissioning for the year ended 30th June X5. So what will the cost of decommissioning is assumed to be an obligation for an entity, and amount should be included in the cost of the asset when it is first recognized on 1st July 2000 X4. So amount to include in the cost of the asset for decommissioning cost is the present value of the expected future decommissioning cost. The present value the amount included in the cost of asset for decommissioning cost is the present value of the expected future decommissioning cost, and the present value is calculated by multiplying the expected future cost by a discount factor, which is in this case is the discount factor for year 5, that is the 2000X9 at 12%, at 12%. So 4 million, and the discount rate given is 0.567 is 2.268 million. Therefore, cost of asset $2.268 million. Provision for decommissioning cost is 2.268 million credit, and the asset is depreciated on a straight line basis over a five years, right? And in addition, the decommissioning cost should be increased to 4 million by the end of year 5. This is done by charging a finance cost each year, and this is charged at the cost of capital of 12% and applied to the balance of the provision account. The finance charge for the year 30th June 2000 X5 is 2.268 million into 12% will get 272,160. Right, so 272,160, and therefore answer will be 725,000. 760 is the total charge to profit or loss, right? 270, 2000 related to this one, the provision of the finance cost and the above cost. How 725,000? Now, see, I know you're still confused. Uh, One is depreciation, 2.268 million divided by 5 years. So that's 453,600. And finance charge 725,160 is the total will be charged to the profit or loss, that is 725,760. Oh, what? Yes, 760, right? So next question. An entity purchased property for 6 million on 1st July 2003. The land element of the purchase was 1 million. The expected life of the building was 50 years and its residual value is nil. On 30th June X5, the property was revalued to 7 million, of which the land element was 1.24 million and the building is 5.76 million on 30th June 2007. The property was sold for 6.8 million. Okay, so what is the gain on disposal of the property that would be reported in the statement of profit or loss for the year to 30th June 2007? Now, look at it carefully. The land element, we have three elements in it: the land element, the building element, and the total. Cost 1st July 2003, 1 million, building is 5 million, and total is 6 million. Okay, so building depreciation, 5 million divided by 50 years is 0.1 million here into 2. So that is zero point 0.2. We will deduct 0.2 from here as well. Carrying amount 30th June 2000 x5, 1 million. We'll get 4.80 million and it's 5.80. Revaluation gain given in the question is 0.24, 1.96, and we'll get 1.20. Revalued amount one point two four, 1.96. Sorry, not 1.96, it's 5.76, the total, and 7. Now building depreciation is 5.76 divided by 48 years is 0.12 per year, multiplied by 2 is 0.24 and 0.24. Carrying amount 30th June 2000 x7, 1.24, 5.52, and 6.76. Disposal proceed given in the question 6.80. Will get gain on disposal 0.04, right? So the gain on disposal is 40,000. That 1.2 million balance on the revaluation reserve is transferred from the revaluation reserve to another reserve account, probably retain earnings, but is not reported through the statement of profit or loss for the year. If you selected answer B, you have forgotten to record depreciation between 30th June 2005 and 30th June 2007. If you selected answer C, you have based the profit on the original depreciation. If you have selected D, you have interactive transferred the remaining revaluation reserve into the statement of profit or loss. Okay. Next question. What is the deferred income liability balance at 30th June 2003? A manufacturing entity receives a grant of 1 million towards the purchase of machine on 1st January 2003. The grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do. The asset has a useful life of 5 years. What is the deferred income liability balance at 30th June 2003? I need to rub this part quickly because I need a space. So just a sec, just a minute, please. Now, so the grant should be released over the useful life, not based on the possibility of the item being repaid. Therefore, the 1 billion should be released over 5 years, being released of 2,000 a year at 30th June 2000 X1 X1 at 30th June X1. It's 6 months, right? From 1st January to here. So 200,000 into 6 divided by 12, what we will get 1,000, 100,000 has been released, and which leaves 1 million minus 100,000. It will leaves 900,000 into the deferred income liability. So it's 900,000. Now on 1st January 2000 X1, STY received 1 million from the local government on the condition that they employ at least 100 staff each year for next 4 years due to an economic downturn and reduced customer demand. On 1st January 2000 X2, STY no longer needed to employ any more staff and the conditions of the grant required full repayment. What should be recorded in the financial statements on 1st January 2000 X2? Reduced deferred income balance by 750,000. No, it's the wrong option. Reduced deferred income by 750,000 and recognize a loss of 250,000. Yes, this is the right option. This is a revenue grant and would therefore be released to the statement of profit or loss over the 4-year life. By the end of year 1, 250,000 would have been credited to the statement of profit or loss, leaving 750,000 held in deferred income. At this point, the amount is repaid, meaning that the deferred income is removed as well as the 250,000 income previously recorded. So B is the answer. Now, sixth question, I mean, which of the following properties owned by Scoop would be classified as an investment property and a property that had been leased to a tenant but which is no longer required and is now being held for resale? Wrong answer. Land purchase for its investment potential planning permission has not been obtained for building construction of any kind. So B is the answer for this one. Yes, because asset would be classified as a non-current asset for sale under IFRS 5 and discontinued operation. Asset C and D would be the classified as property, plant, and equipment. Next question. During the current year, an entity had in place 1 million in 6% loan finance and 2 million of the 9% loan finance. It constructed a new factory which cost 600,000, 600,000, and this was funded out of the existing loan. The factory took 8 months to complete. To the nearest thousand, what borrowing cost should be capitalized? So the weighted average cost of borrowing is 8% in this case, right? So 1 million into 6% plus 2 million into 9% divided by 3 million. Therefore, amount to be capitalized is 600,000 into 8% into 8 divided by 12 is 32,000. So next question, which of the following is correct? Statement 1, if the revaluation model is used for property, plant and equipment, revaluation must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the value at each reporting date. Yes, it is the right answer. And next one, when an item of property, plant and equipment is revalued, there is no requirement what the entire class of assets to which the items belongs must be revalued. It's false. Okay. Now, moving ahead. IS 16 states that when the revaluation model is used, revaluation should be made with sufficient regularity to ensure that carrying value of the assets remain close to the fair value. IS 16 also states that if one item in class of assets is revalued, all the assets in that class must be revalued. Okay. Now, next question. Which two of the following items should be capitalized within the initial carrying amount of an item of plant? Cost of transporting the plant to the factory? Yes. Uh, Cost of installing a new power supply required to operate the plant? Yes. Both are right, are the will be capitalized because the maintenance and the training cost should be expense as incurred, and the residual value should be taken into account for the purpose of calculating depreciation, but not for the amount to be capitalized. Right. Uh, Tibbet acquired a new office building on 1st October 2004. Its initial carrying amount consisted of land 2000, building structure, air conditioning system. The estimated life of the building structure and air conditioning systems are 25 years and 10 years respectively. When the air conditioning system is due for replacement, it is estimated that the old system will be dismantled and sold for 500,000. Depreciation is time apportioned where appropriate. At what amount will the office building be shown in Tibbet statement of financial position? So land 2000, which is not depreciated. Building structure 10,000 minus 10,000 divided by 25 multiplied by 6 divided by 12 is 9,800. Okay. Air conditioning system 4,000 minus 3,500 divided by 10 into 6 divided by 12 is 3,825. 15,625. Let's see. Yes, A is the answer. 11. The following trial balance extracts relates to property which is owned by Wheaton as at 1st April 2004. Property cost 20-year original life, 12,000 accumulated depreciation as at 1st April 2000 X4 3600 on 1st October X4 following a sustained increase in property prices. Wheaton revaluates its property to 10.8 million. Okay, what will be the depreciation charge in Wheaton statement of profit or loss for the year ended 31st March 2000 X5? So year end is 31st March X5, right? And it extracts the trial balance extract at 1st April 2000 X4. Property at cost accumulated depreciation on 1st October, a falling sustained increase in property value and very valued since property at so 10.8 million. Yeah, so see, year starts at 1st April, year end is 31st March. The revaluation takes place on 1st October. So that's the 6 months here, right? That's the 6 months. So 10,800. The life remaining is 13.5 years and it will be depreciated over the 6 months. So total depreciation is 700,000 in this case. Wish to following statements about IS 20 accounting for government grants and disclosure on government grants assistance are true. A government grant related to purchase of an asset must be deducted from the carrying amount of the asset in statement of financial position. That's the wrong one. Government grant related to the purchase of an asset should be recognized in profit or loss over the life of asset. Yes, this is the right one. And free marketing advice provided by the government department is excluded from the definition of government grant. Yes, this is also right because item A is incorrect as a deferred income method can be used. Item D is incorrect as any repayment is corrected in the current period, not retrospectively. Okay. Next question. Uh, Simpson Company purchased a new building with a 50-year life for 10 million on 1st January 2000 X3. On 30th June 2000 X5. Be careful about the dates, folks. Smithson Company moved out of the building and rented it out to rent third parties on a short-term lease. Simpson Company uses a fair value model for investment properties. At 30th June, the fair value of the property was 11 million. At 30th December, it was 11.5 million. What is the total net amount to be recorded in the statement of profit or loss in respect of the office for the year ended 30th 1st December 2000 X5? Cool. So 6 months depreciation again, right? Because the year end is 31st December. See, 1st January to 31st December, right? And they purchase a new building with a 50-year life on 10 million on 1st January, actually on 30th June. So here is 30th June. That means 6 months. Samsung company move out of the building and rent it out to third parties on a short-term lease. Fair value of the investment 30th June X5 of the was 11 million, right? And so over till here, 10th million divided by 50 years into 6 divided by 12, we'll get 100,000. When the asset is transferred to investment property, it should be revalued to the fair value of 11 million, right? At the date the asset is used is changed, this should be recorded in other comprehensive income and in revaluation surplus. and not in the statement of profit or loss. From this date, the fair value model is used. No depreciation is accounted for, but the asset will be revaluated to the fair value with gain or losses through the statement of profit or loss, right? So there is a gain of, so there is a gain of 500,000 from 30th from June 2000 X5 to December X5. This would be included in the statement of profit or loss. So therefore, total net income will be total net income will be 400,000, being the 500,000 fair value gain less the depreciation expense of 100,000 for the first 6 months, right? Because total 500,000, but less 100,000 depreciation, which we calculated above for the first 6 months. So the total gain will be 400,000, right? So net income is 400,000. Moving out to the next question, the 14th question. What are the total borrowing costs to be capitalized in respect of the warehouse? Okay. Gilbert took out a 7.5 million on 1st January 2006 to build a new warehouse during the year. Construction of the warehouse began on 1st February X6 and was completed on 30th November X6. As not all the funds were needed immediately, Gilbert invested 2 million in 4.5% bonds from 1st January to 1st May 2006. As you know, the interest can only be capitalized during the period of construction, which is in the form, which is from first Feb 2000 X6. Therefore, the interest can be capitalized for 10 months, being from first Feb to 30th November is 10 months. This gives us how much? 7.5 million. Interest rate is 10%. It's 10 divided by 12 months. How much we get? We get 625,000 till now. Any temporary investment income earned during this period should be net off to the amount capitalized, and the amount earned from 1st February to 1st May X6 is 2 million into 4.5% into 3 divided by 12. 22,500. Therefore, amount to be capitalized is 625,000 minus 22,500 is 602,500, and all interest incurred and earned in January excess is before the construction period and therefore recorded in statement of profit or loss. So 600 to 500 is the answer. Croft acquire a building with a 40-year life for its investment potential for 8 million on 1st January X3 at 30th December X3. The fair value of the property was estimated at 9 million with cost to sell estimated at 200,000. If Cross uses the fair value model for investment properties, what gain should be recorded in the statement of profit on 31st December 2000 X3. 2000 X3. So what will say that 9 million minus 8 million, that is 1 million. is taken to the statement of profit and loss. Cost sales are ignored, and since Prof uses the fair value model, no depreciation will be charged on the building, so it's 1 million. Next question. Which of the following cannot be recognized as an intangible non-current assets in GHK consolidated statement of financial position as of 30th September X1? Okay. So GHK spent 132,000 developing a new type of product in June 2001. Management worried that it would be too expensive to fund the finance to complete the project. Came from a cash injection from a benefactor received in November X1. And here A is the answer. The finance was only available at the year end. Therefore, the criteria of recognizing an asset were not met as the resources were not available to complete the project. Even though the brand is internally generated in the subsidiary accounts, it can be recognized at fair value for the group. Item C can be recognized as a purchase intangible, and item D means the criteria for being capitalized as development cost. Next question. Which of the following could be capitalized as development expenditure in M statement of financial position at 31st March 2000 Y0 according to IS 38? Well, 120,000 spent on developing a prototype and testing a new type of propulsion system. The project needs further work on it as the system is currently not viable. It cannot be capitalized because it does not meet all the criteria as it is not viable. Now, next, a payment of 50,000 to a local university engineering faculty to research new environmental friendly building techniques. Well, it cannot be capitalized as well because item B is research, and research cost will be expense and cannot be capitalized at all. Then 35,000 developing an electric bicycle. This is near completion and the product will be launched soon. As this project is first of its kind, it is expected to make a loss. So item C cannot be capitalized because it does not meet all the criteria as it is making a loss. So D, 65,000 developing a special type of new packaging for a new energy efficient light bulb. The packaging is expected to reduce M's distribution cost by 35,000 a year, will be capitalized only. Right, moving to the next question. Question number 18. Which two of the following factors are reasons why key staff cannot be capitalized as an intangible asset by an entity? So they do not provide expected future economic benefits. No, it's not a right one. They cannot be controlled by an entity. Yes, correct. Their value cannot be measured reliably. It's also correct. So B and C is the right. Key staff cannot be capitalized as firstly, they are not controlled by an entity. Secondly, the value that one member of the key staffs contribute to an entity cannot be measured reliably. Question number 19. Moving on to the next question. Question number 19. The cost of 750,000 relate to 10 months of the year up to April 2005. Therefore, the cost per month were 75,000. Okay. Mcq carries out research and development in the year ended 30th June X5. Mcq incurred total cost in relation to the project 750,000, spending the same amount each month up to 30th April. When the project was completed, the product produced by the project went on sale from 31st May X5. The project had been confirmed as feasible on 1st January, and the product produced by the project was expected to have a life of 5 years. What is the carrying amount of the development expenditure as at 30th June X5? The cost of 75,000, 750,000 related to 10 months. That means up to April 2000 X5. Therefore, the cost per month was 75,000. As the project was confirmed feasible on 1st January, the cost can be capitalized from this date. So 4 months of this cost can be capitalized. So 74 months can be capitalized. So that means 75,000 multiplied by 4 will get 300,000. The asset should be amortized from the project. Products go on sale. So 1 month amortization should be charged to 30th June X5. Amortization is 300,000 divided by 5 into 1 divided by 12 is 5,000. The carrying amount of the asset is 300,000 minus 5,000 is 295,000. The asset should be amortized from when the products go on sale. So 1 month amortization should be charged to till 30th June X5, and amortization is as I told 30th June is 5,000. The carrying amount of the asset at 30th June is 295,000. So if so 295,000 is the answer. But if you chose C, you have forgotten to amortize the development cost, and if you chose B or D, you have either capitalized the full amount or capitalized none of the costs. So far, so good. Moving ahead. CBIL has acquired a subsidiary Basel in the current year. Basel has a brand which has been reliably valued by CBIL at 500,000 and a customer list which CBIL has been unable to value. Which of this describes how CBIL should treat this intangible assets of the Basel in the consolidated financial statements? Okay, so they should be included in the goodwill. No, wrong one. The brand should be capitalized as a separate intangible asset, whereas the customer list should be included within goodwill. Yes, right one. B is the answer, because the brand can be majorly reliable. So this should be accounted for as a separate intangible asset on consolidation. The customer list cannot be valued reliably and so will form part of the overall goodwill calculation. It will be subsumed within the goodwill value. We are done with the 20 questions so far.